This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, we've now seen over the first two sessions how it is we put our calculation together of taxable gains. That's the summation of all our individual gains and any allowable losses. In terms of those gains and losses, important to ensure that where there are gains that would be subjected to different tax rates, for example, residential property as compared to other assets, as then compared to assets qualifying for entrepreneurs relief, then it's important to maintain separate records of each so that when either losses or thereafter AEA is deducted, that those deductions are made firstly from the gains taxable at the highest tax rates. Obviously there, residential property before other assets, before assets qualifying for entrepreneurs relief. The makeup of each gains calculation is very simple. We need to look at the sales proceeds, less any selling expenses, less any and all allowable costs to give us either gain or loss. What we look at now is just those individual figures in a bit more detail. Are there any issues there that might pose problems, as we will see? So first of all, again, here in Chapter 12, Section 1.8, picking it up from where we were last time, what about the disposal proceeds? So the actual consideration is used when a bargain is made at arm's length, i.e. we sell an asset to a third party, we sell it for as much as we can get for it, and therefore we use those sales proceeds in computing the gain. But you will recall that we said right at the very beginning of our discussions of CGT that a gain would arise wherever there was a chargeable disposal. And a chargeable disposal wasn't just a sale. It could be the gift of an asset. Therefore, if it were to be gifted, for example, then market value would be used when dealing with the disposal by means of a gift. Where there is clearly a donative intent between the seller and the buyer, the donor and the donee, we will always use market value. And that will hold true whether or not it's an outright gift. I have an asset worth £30,000, I give it to my son. We use market value of 30,000 in computing my gain. Or I can't quite afford to give it outright to my son, so I sell it to my son at undervalue. I say, okay, son, it's worth 30, I'll sell it to you for 10,000. Those actual proceeds that there exist don't impact on any gains calculation. The gain is always based on market value. Now, a gift, of course, could be made either in lifetime or in terms of death. Now, in terms of in lifetime, the market value when I make the gift is used for my calculation of the gain, and it becomes the base cost to the donee. If I die, leaving such assets to my kids there, on that basis, there is no CGT for me on death. Sadly, as we'll discover in a later chapter, we've got inheritance tax that may indeed punch a big hole in what is left of my estate there. We've got IHT, but there's no CGT. And the kids, again, would acquire at market value there. They'd be deemed to have acquired at market value. Another name that might be given to that market value that exists at the date of death, the probate value. So again, you might be asked to deal with the disposal by a taxpayer of an asset. You know what it is now sold for, or if gifted, what is its market value, but you are told that it was not acquired by purchase, it was acquired by gift. And this individual had acquired it when somebody else gave it to them upon their death. And what they then quote is the probate value of the asset at that date. Just a fancy word for the market value at the date of death of the taxpayer. That to the donee, to the beneficiary there, becomes their base cost. There is just one little valuation rule that we need to know at this level, and that's when dealing with quoted shares. Because with quoted shares, at the end of the day upon which they have been gifted, clearly if they've been sold, then there's no problem. You know what those sale proceeds are. That fits into your gains calculation. But you've given these shares away. Well, at the end of that day, there will be two prices quoted, or even prices quoted. there will be two prices quoted there indeed, a sort of bid and offer price. What we have is a rule as to, well, if there's two prices, which one do we use? Well, it's a very simple rule. We don't use either. We use a simple average of the two, otherwise known as the mid price here. So when quoted shares are gifted, the value may not be given in the exam and should be calculated as the mid price based on the day's quoted prices given in the question. So at the end of the day, therefore, we'll get these two prices quoted. So for example, Jenny gifted 1,000 shares in MPLC when they were quoted on that day, at the end of the day, at £4/£4.08. Therefore, what do we use? The mid price, a simple average of those closing prices. Halfway between £4 and £4.08 will be £4.04. Applied to the 1,000 shares, bang. That will be the market value to use in any capital gains calculation. It's not a difficult rule. Having got your disposal consideration, we then need to deduct any selling expenses, any incidental costs on sale, and they would include, if you're selling a property, there will be legal fees there. In selling anything, you may have to advertise, so there's advertising fees. If you put it into auction, it might be an antique or something that you have, auctioneer's fees. Or again, with something like a property, rather than just pure advertising fees, well, of course, the agent may be selling that for you, and therefore the agent's fees are deductible. All of those perfectly allowable selling expenses to be deducted from the disposal consideration to give you net proceeds. Whereas we'll see as this chapter goes on, where we may have more of an issue is in terms of our allowable costs. Now, to begin with, again, it's not difficult. Costs will include, well, whatever you bought it for, the cost of acquisition, or of course, if it was gifted to you, the market value at the date you acquired it, and any other incidental costs of acquisition. Again, you bought a property. You incurred both the price of the property and also you incurred legal expenses thereon. If an asset, as we said, was required as a result of a gift to the taxpayer, it will be deemed acquired at its then market value. Now, from the point you bought it, you might go on and incur further expenditure, otherwise known as enhancement expenditure, improvement expenditure. Like again we discussed at the very beginning of this chapter, you buy a property and you build on an extension, a conservatory, a garage there. Those costs have clearly enhanced the value of what you then go on to sell when ultimately you dispose of that property. So any such and all costs, again, will be allowable. Now, having taken account of what is the disposal consideration, what are your selling expenses, what are your allowable costs, you don't always get a chargeable gain arising. What we might have, of course, as here in section 2, we see losses. What do we do with them? We already know the answer to this. Any gains and losses during the tax year for the individual must be netted out. So, where capital losses arise, they are set against gains in the same tax year. We know we must net out gains and losses of the year. The set-off is made to the maximum possible extent. It cannot be restricted to avoid wasting the AEA. So, for example, if during this year I had made so far gains of £10,000 and I was about to make a disposal of one more asset, and on that asset it would appear that I'm going to sustain a loss of £8,000. Would there be any point in terms of tax saving this tax year of yielding that loss in the current tax year? And the answer to that question should be no. There's no saving, there's no benefit gained from yielding that loss this year. If we only make that gain this year, it is 10,000. What do we have available? We have an AEA of 11,300 that will more than eliminate that gain. Our taxable gains would be nil. If I yield that loss this year, my net gains are £2,000, more than a gain covered by our AEA. You have wasted that loss. You have used 8,000 loss to go against a gain, no part of which would otherwise have been taxable. But if you choose to dispose of both those assets in the same tax year, then that will be the outcome. There will be net gains of 2,000. You've effectively wasted the loss by using it against gains that would not have been taxed anyway, because again, the AEA would have covered it. So let's just get a little bit of blank paper here to look at. If we go through looking at 3 years, we'll just use 3 years here. And like we've just said, in year 1, we've made gains of £10,000. And let's say it's your client now suggested that they were going to make that other disposal and yield a loss of 8,000. Our advice should be, don't actually dispose of that asset this year. Wait until year 2 and then make the loss of 8,000. That gain is covered by the AEA of 11,300, so there are nil taxable gains. But what benefit is to be gained by making the loss next year? Well, obviously what you might be thinking is maybe we'll have a great big gain next year against which to offset that loss. And in that way, we would gain some benefit from it. It would remove some gain that would otherwise be taxable. But what I'm going to do to you now is to tell you that in fact that doesn't happen. That the only transaction there in year 2 is that loss of 8,000. So what happens to it? If now in the year we have a net loss, that net loss is carried forward to set off against future chargeable gains. We've seen already on our pro forma against the net gains of the year, we then deduct capital losses brought forward. This here is how a capital loss brought forward would originally have arisen, by in a tax year there being more losses than gains. And so we come through to year 3, the third and final year here in this particular example, and our pièce de résistance here in terms of this example. Because now in year 3, there are 2 disposals. One yields a gain of, say, £16,000. The other yields a loss of, say, £2,000. So what now must we do? What we must do is to net the gains and losses of the year. So that, therefore, will bring it down to net gains of 14,000. Now, once you've got your net gains of the year, 14,000, what do we then do? We have 2 deductions that may then go against it. Losses brought forward, which of course we have here, and then less our AEA, which we'll just assume is a constant throughout these 3 tax years at 11,300, to bring us down to what then might be any taxable gain. Right, before we jump to any conclusions, we know that in year 3, the loss brought forward is the £8,000 of losses made in year 2. Now think, after having applied the loss brought forward, what figure of net gain would you wish to have here prior to deducting our AEA? That figure, of course, would be 11,300 in order that taxable gains are nil and we therefore do not waste any of that loss brought forward. And this is where you must learn the distinction between the tax treatment of a capital loss brought forward as compared to a capital loss of the year. In the year, what must you do? You must net out gains and losses of the year. Whether that means you get any tax saving from the use of loss is irrelevant. You have no choice. You must net out the gains and losses of the year. But when you apply a loss brought forward, though as you can see there, it is deducted before we deduct the AEA, stick to this order of set-off, please. When you deduct the loss brought forward, you only have to use sufficient of that loss so as not to waste any of this AEA, i.e. to bring that net gain down to 11,300. So, of a loss brought forward of, we had 8,000. How much of that do I want to use here in year 3? Answer, 2,700. If I use 2,700 out of the 8,000 available, that will bring down my net gains of the year to 11,300, just sufficient to absorb that AEA and to end up with nil taxable gain. It also means, rather than wasting some of the loss brought forward, I'll now have some loss to carry forward. I started with 8,000, I've used up 2,700, that therefore, that will still leave me with £5,300 to carry forward there. 5,300 methinks. So, very good news in terms of the tax treatment of a loss brought forward. Again, you could very easily get an objective testing question identifying there effectively what would be happening in year 3 with the various different outcomes. So do please distinguish between the loss of the year and the loss brought forward. Back therefore to our notes. As we've said, if there are insufficient gains in the year to set off the capital losses in the year when they arise, the unrelieved capital loss will be carried forward. Current year capital losses are deducted in priority to capital losses brought forward. The capital losses brought forward, however, will only reduce the net gains to the level of the AEA and will not therefore waste the AEA. And as we've just seen, any capital losses brought forward that remain unused continue to be carried forward. Very good news indeed. Okay, over to you now. We've got a little example here, example 7, where we've got 2 taxpayers, Fiona and Jane, each of which for 2 tax years, 16-17 followed by 17-18, have a mix of gains and losses. Deal firstly with Fiona, then deal with Jane, calculating, if any, the taxable gains for the taxpayers for each of those 2 tax years and identifying, where appropriate, the amount of any losses carried forward at the end of the 17-18 tax year. Okay, over to you. Have a go. Check that out, please. And then we'll talk through that again when you've completed. So pause, please, at this point in time. Okay, hopefully not too many problems, if any indeed there, in dealing with these 2 taxpayers and establishing net gains or net losses so far as the tax year is concerned. Firstly, Fiona here in 16-17, the first of the 2 tax years you had to look at. Gains must be offset against losses of the year, and whatever net gain arises, that's it, you can't change that. Whether that loss has been of any use to you in reducing gains that would have been taxable or gains that would be covered anyway by the AEA is irrelevant. There is no choice, you must net out the gains and losses of the year. We get here a net gain of 5, that of course is less than the AEA, so there is no CGT liability that would arise, and there are no unused losses to carry forward because it had a net gain of the year. Into the second of the 2 years, we must offset the gains and losses of the year. The net gain is 11.8. This time we're above the AEA and therefore end up with taxable gains of £500. And once again, no losses to carry forward. Somewhat more interesting, the situation for Jane. In 16-17, we have more losses than we have gains. So there are nil gains taxable in that year and unable to use her AEA, but it does mean that we have net losses of £3,000 to carry forward there, at least until 17-18, or indeed without time limit to go against any future gains. But when it is carried forward, we only have to use those losses against those net gains of a future year in excess of the then AEA. So what happens in 1718? Again, we must net out the gains and losses of the year. That leaves us with 11,700. How much capital loss do we have brought forward? 3,000. But we only have to bring down our net gains of the year to the amount equal to the AEA, so as to leave us with a nil taxable gain and utilise the minimum amount of the loss brought forward as will be necessary. So in getting from 11,700 down to 11,300, clearly I only have to use 400 out of the £3,000. So on that basis, therefore, it'll still leave me with £2,600 of the capital loss to continue to be carried forward. When we carry forward that unused capital loss, it'll never be wasted by going against gains that would be covered anyway by the AEA. It will only go against gains that would not otherwise be covered by the AEA. So we'll always get good use out of it, assuming, of course, that in the future, before the taxpayer dies, that there are such gains that will indeed arise. Okay, let's go back to the text, therefore, and to the next area. And we're now talking about transfers of assets that occur between either spouses, husband and wife, or between civil partners. Again, we know whether we're talking about spouses in terms of a marriage or civil partners. In terms of a civil partnership, we always have the same taxation treatment. We saw what the issues were when dealing with income tax. Now we see what happens as regards capital gains. And what we have here is another set rule. A rule that applies, but which we, as either spouses or civil partners, could actually take advantage of to improve the mutual tax position of the two spouses or of the two civil partners. So what have we got? Any transfer of assets between spouses or civil partners is for CGT purposes deemed to take place at a value that would give rise to neither a gain nor a loss. We can refer to this as being a nil gain, nil loss transfer, or as I'll refer to them as a no gain, no loss transfer. What that effectively means is that the transferor is deemed to make the disposal at cost rather than at market value. That figure, of course, if we transfer at cost, if that's the disposal consideration, it is the same as the cost, then neither a gain nor a loss arises. So when we talk about a no gain, no loss transfer between spouses, between civil partners, it means the transfer is deemed to have occurred at cost. Dispose at cost, and the transferee, therefore, acquires the asset at the original cost of the transferor. Now, clearly HMRC have this for a reason. Remember, each of us, each year, spouses, civil partners, we exist independently in terms of taxation. So if I had an asset that, up until this tax year, had increased in value by, say, £10,000, and I thought that next year it was going to go up by £3,000, £4,000, £5,000. Now, as soon as my gain goes above in any one year the level of the AEA, currently £11,300, that of course would mean that we're going to pay tax on it. And if I don't use my AEA of a tax year, then I lose it. Again, the principle, use it or lose it there. So I might have a cunning plan. I want to keep hold of this asset because I think it's a good investment. So what I think I'll do, I'll sell it to my wife, crystallise the gain of £10,000. She then takes at a cost bigger. I bought it for 20,000, it's now worth 30,000. If I could transfer it to her for 30,000, then I make a gain of 10. It's covered by my AEA. She's got a cost of 30,000. We wait until the asset has then gone up to a value of, say, 40,000. She sells it back to me. She makes a gain of 10, covered by her AEA. I've got it back again, now with a cost of 40,000 rather than my original 20. It won't work, because when I transfer to my wife, it will go at my cost of 20,000. That becomes her cost. Therefore, no benefit is gained. But that rule we as taxpayers can actually exploit to our own best interests. So the no gain, no loss transfer rule here may be used by taxpayers, one, to utilise the AEA of both parties. So I therefore have two assets, each of which will yield gains of about £10,000. My wife has no assets that she is going to dispose of in the current tax year. If I sell both of those assets, I make gains of £20,000. I've got an AEA of £11,300. I've got a taxable gain of £8,700, and therefore I'll pay CGT thereon at whatever is the relevant CGT rate. What would be a better idea is, rather than me using all of my AEA and then having a taxable gain that I have to pay tax on, while my wife does not use any of her AEA, and it is therefore for this year wasted, that what I do is this. I keep one of the assets and transfer the other to my spouse. That goes on a no gain, no loss basis. So now, having gone to her at cost, I sell my asset to the third party, she sells her asset to the third party, and each of us make gains of £10,000. Sufficient, therefore, to cover each of our AEAs. Between us, we've made £20,000 of gain, only this time had no taxable gains. We won't pay any tax. So we've been able to use both of our AEAs by using the no gain, no loss transfer, one spouse to the other, prior to a sale to the outside world. So there's one use, to use our AEAs. Or to take advantage of capital losses. One spouse has got losses, the other doesn't. Therefore, we could use that loss against gains via a no gain, no loss transfer, and then the spouse with the loss. That then person makes a sale to the outside world, yields a gain, and it's covered by, or at least to some degree, by the loss. Or the other most likely one, lower capital gains tax rates. For example, it would be better for each spouse to yield gains of £10,000 each, rather than one spouse to make gains of £20,000, the example that I just gave to you. It would also be better for a basic rate taxpayer to yield any taxable gains, because they would be taxed at 10% if they're other assets, 18% if it's residential property. Instead of, if the spouse is a higher rate taxpayer, who would then be taxed at either 20 or 28%, the higher rates on those gains. So a little question for you, therefore. I'm going to set you a little planning problem now, so make a note of the following information, please. It's ever so simple. Could you note that we've got our spouses? One spouse informs you, let us say it's her, that she has taxable income of £50,000. I'll write this down for you, otherwise it might get a little bit confused. So wife, therefore, of her income tax computation, has taxable income of £50,000 each tax year. And she is about to sell 3 assets and make gains of £10,000 on each of those assets. Husband, hubby, he has got taxable income of £20,000. Didn't he do well? He's got taxable income of 20. The wife, where's that gone? The wife there, bless her, has got taxable income of £50,000. And he has got no assets that will be sold either this year or next year. So, what I'd like you to do first of all is to work out for me, remember the wife's current plan is that she now will sell off these 3 assets, making gains of £10,000 on each asset equals £30,000 worth of gains. You also know that with that level of annual taxable income, that she is going to be a higher rate taxpayer. So I'd like you to work out with their plan, the spouses at the moment, of what they intend to do, how much CGT would be paid by the wife. And then for you to consider how you might reduce that CGT, clearly by the use of no gain, no loss transfers. He has no other assets that he'd be selling. At the moment, we are wasting his AEA. He has taxable income of $20,000. He is but a basic rate taxpayer. So you've got to consider, therefore, and then work through what revised CGT liability might there be with your plan, which is how best to take advantage of the use of no gain, no loss transfers. Right, you have a think about that, work those tax figures for me, please, and then we'll come back and see what you've got and see how quickly you can save how much tax for your clients here. Okay then, let's finish off this session by dealing with now our tax planning strategy. At the moment, the taxpayers' plan, they don't know anything about the chargeability of gains or CGT liabilities. Their original plan is the wife is going to sell off her 3 assets that she intends to sell, yielding therefore gains all in this tax year of £30,000. That therefore will be covered partly by the AEA, still leaving most of that gain as a taxable gain, and as she is a higher rate taxpayer, the taxable gains of £18,700 will be taxed at 20%. I think, therefore, quickly doing that in my head, was £3,740 there as regards her CGT liability. Now, that's a big amount of tax to pay. So what's our revised plan? Because at the moment, she is selling all using her AEA, and her taxable gains are then taxed at 20%. In so doing, we are wasting, therefore, husband's AEA and his remaining available basic rate band. In which case, therefore, clearly, we're going to transfer at least 1 and possibly 2 of those assets from her to him. On a no gain, no loss basis, he then sells those that 1 or 2 assets to the outside world, and he yields those gains. So the question is, what should she do? Should she transfer 1 of her assets over to him, or should she transfer 2 assets? She's always going to keep at least 1 asset because she has available her AEA. She's always going to transfer at least 1 asset to him to sell to the outside world because he has his AEA. Now, at £10,000, £10,000 on each of 2 assets, both of those are covered by AEA. But the third gain of £10,000 is either going to be taxed on her or him. Who would you want any taxable gain to be taxed on here? Her at 20% or him at 10%? It's a given, isn't it? So our advice, I hope you have correctly determined, is that the wife should transfer 2 assets, they being, there is no choice here, on a no gain, no loss basis across to husband, and she sells the remaining asset to a third party. So she therefore has a gain in the year of £10,000, which of course will be covered by her AEA of 11.3, so she's got nil taxable gains. We transferred 2 across to the husband. So for husband, therefore, or hubby, he's going to have gains when he sells to the outside world of £20,000. He's got his own AEA for the year, 11.3. That means that he will have taxable gains here of, what's that, 8,700, and he will pay tax on those. Remember, his current taxable income each year is £20,000. So he has available some £13,500 of remaining basic rate band. This taxable gain is nowhere near that at only 8.7, so it will be taxed, therefore, at 10%, which of course will be £870. So under the revised plan, she pays no tax, she's got nil taxable gains. He pays tax of £870. A total liability of £870, which compares, I'm sure you would agree, rather favourably to the original plan that they had, that she would sell all assets to third parties and make gains and then pay tax of £3,740. That £3,740 has been brought down to £870, a saving of nearly £3,000. And did it take us long to figure out that plan here? No, it didn't. Again, what we're doing, making use of each spouse's AEA, and then each spouse's, if they have any, basic rate band available, so as to minimise the tax charges felt mutually by the couple here. Now, in fact, some of you might have done better than even that, a tax charge of £870. What some of you might have come up with is, with slightly different and slightly more flexible planning, that they'd have no tax at all. And how would we do that? By simply delaying one of those disposals to the next tax year. Wait until the following 6th of April. If this year she transfers one asset, no gain, no loss, to him, he sells that one, he's got a gain of 10, no tax. She sells one of her assets to the outside world, she has a gain of 10. Both therefore covered by the individual AEAs. She keeps the third asset until next year. Now again, depending on whether she plans any more disposals in that year, either she or through no gain, no loss transfer, he could yield that third gain of 10,000 covered by next year's AEA. So as long as she'd be willing to wait to actually yield that third gain till the next tax year, there's no reason why any tax should be paid, and you could save the entire £3,740. Pretty basic but incredibly important tax planning that now we could advise our clients about. Okay. Can you please, before I see you again next time, there's a little example there, example 8, Gollum there, bought a ring, that's a surprise, isn't it? And transferred to his civil partner, Frodo there. Can you work it out there? Any capital gain for Gollum or Frodo in the tax year? That still leaves us, I'm afraid, as we said, it was a big chapter, this one, with a few more areas for us to hopefully see off in the next session together.